Last week, the United States government spent billions of dollars buying Japanese yen, not investing in Japan, not doing a trade deal. The US Treasury, executing through a Federal Reserve Bank of New York, went into the foreign exchange market and bought another country's currency to stop it from collapsing. Yikes. We know this happened partly because Reuters photographed Scott Bessent's notepad during a cabinet meeting at Camp David. In his handwriting, under the to-do list, was buy Japanese yen, $5 to $10 bill. Now, this is how we find out how a joint currency intervention is happening. Someone photographs the Treasury Secretary's homework. To actually understand why the two of the world's largest economies coordinated an emergency action on a currency, you need to know where the yen has actually been. A year ago, the US dollar bought up approximately 142 yen. By late July 2026, it bought up close to 164 yen. That is a collapse of roughly 15% in a year. This is on top of years of prior weakness. The yen hits its lowest level against the dollar in approximately 40 years, since 1986. For most currencies, a 15% move in a year is a crazy shift. For the yen, it is a crisis with a specific painful consequence. Japan actually imports most of its energy. Energy is priced in US dollars. When the yen weakens, Japanese households and businesses pay more for electricity, petrol, and heating, denominated in a currency that is getting more expensive relative to their wages. This means inflation rises, living standards fall, the political cost is direct. Prime Minister someone needs to teach me how to pronounce his names because I can't fucking read. Approval ratings have been under pressure specifically because of what the yen weakens and what it's done to household budgets. So Japan intervened. What does this intervention actually mean? Currency intervention is when a government or a central bank directly buys or sells its own currency in the open market to push the exchange rate in a desired direction. Japan's mechanism is very straightforward. It holds large foreign currency reserves, primarily US dollars accumulated over decades of trade surpluses. When the yen weakens too far, the Ministry of Finance instructs the Bank of Japan to sell some of those dollars and buy yen, and thereby increase demand for yen, which pushes its price up. Now, obviously, this is not free. Every intervention draws down Japan's reserves. Japan's foreign reserves fell by 12.4 billion in just July, largely because of dollar selling, and it is temporary, okay? Intervention can move the exchange rate in the short term, but it cannot actually change the underlying structural reasons the yen was weak in the first place. Now, Japan has been doing this repeatedly. In April and May of this year, Japan spent roughly 9.7 trillion yen, approximately 62 billion US dollars, intervening to support the currency. It worked for a few weeks, the yen then resumed falling. By late July 2026, the yen was back at its 40-year lows and Japan was facing a huge problem. It was running through its intervention ammunition and solo action was just not enough. Now, here's why the US got involved. The United States does not typically intervene in currency markets, not regularly. The last time the US Treasury directly bought yen was in 2011, when the two countries coordinated action to weaken the yen, the opposite direction, after the Tohoku earthquake and the tsunami devastated Japan's economy. So why are they doing it now? The stated reason, or the joint statement from Japan's Ministry of Finance, says the intervention was aimed at addressing excessive volatility and disorderly movements of the yen, carried out by a bilateral agreement between the US and Japanese finance ministers. Now, here are the reasons. First, a weak yen is not entirely in America's interest. Despite what the exchange rate might suggest for US exports, Japan holds approximately 1.1 trillion in US Treasury securities, the largest foreign holding of American government debt. When Japan intervenes solo, it has to fund that intervention by selling dollars, which often means selling US Treasuries. Large-scale Japanese sales of US Treasuries push Treasury yields up, which increases borrowing costs across the American economy. By helping Japan intervene through the FIMO repo facility, a mechanism that lets Japan borrow dollars temporarily by pledging its treasury holdings rather than selling them, the US reduces the risk of Japanese treasury selling, flooding the market. Second, Treasury Secretary Scott Bessent had already said publicly that the yen seems very undervalued. He's repeatedly pushed Japan to raise interest rates, which would close the interest rate differential that is the primary structural reason the yen is weak. The intervention is consistent with that stated position. Third, the mechanics. The Federal Reserve Bank of New York sold euros and bought yen through Goldman Sachs and Morgan Stanley on behalf half of the US Treasury, not dollars, euros, which means the US was drawing on its own foreign currency reserves, euros it held, rather than printing dollars or selling treasuries. A detail that is technically significant and almost entirely underreported. Now, let's talk about the structural problem that this intervention cannot fix, something that we mentioned before. Every single analyst covering this has said a version of really just the same thing. The fundamentals driving yen weakness have not changed, and the intervention alone cannot fix this. The core problem is interest rates. Japan's central bank rate is 1%. After raising it in June, the highest level since 1995, the US Federal Reserve benchmark rate sits around 3.5 and 3.75%. The gap matters enormously in currency markets. People are more likely to invest their money in US dollars rather than yen because there's higher return. When the US rates are higher than Japanese rates, international investors have strong incentive to hold dollar-denominated assets rather than yen-dominated ones. Money flows towards higher yields, as I just said before. The demand for dollar assets and the corresponding selling of yen is the primary structural reason the yen has been weakening for years. Borrowing cheap yen to invest in higher-yielding dollar assets. Operating at a global scale. Millions of individual transactions, each rational in isolation, collectively pushing the yen lower. Intervention buys time by changing the price signal temporarily. It does not change the incentive for investing in the yen. The Bank of Japan's path to actually fixing this problem is raising interest rates significantly, closing the gap with the Fed, but Japan's economy and decades-long fight against deflation make aggressive rate hikes politically and economically very, very risky. Raising rates too fast could tip Japan back into a recession. The Bank of Japan is navigating between a weak currency damaging households and rate hikes damaging growth, with really no clean solution. Now, why does this matter beyond Japan, and why does this matter for the world? The yen is just not some random currency, okay? It is the third most traded currency in the world. Japan is the world's fourth largest economy, and Japan investors, individuals, pension funds, insurance companies hold enormous amounts of foreign assets, particularly US treasuries and equities, accumulated over decades. When the yen weakens significantly, Japanese investors face a dilemma. Assets held abroad are worth more in yen terms, which is good, but if they repatriate those assets, sell the foreign holdings and bring the money home, they add to the yen supply and push the currency down further. And if the yen becomes too weak, there is a political and institutional pressure to bring assets home regardless. The US genuinely has a direct reason and an interest in ensuring Japan's currency does not go into free fall. Now let's look at the numbers. Let's see what actually happened with this intervention. Before the interventions, the yen was trading 162 per dollar. After Thursday's solid Japanese intervention, Friday's joint action closed at 157.4. As of Monday morning, it sits around 157.7. That is roughly 4% move in a few days, which is really significant for a major currency. Speculative traders who were short yen, betting on further weakness, now have to price in the possibility that two of the world's largest economies will actively work against their position. Fuck you forex traders, you dumb pieces of shit. Now let's close this off. What happened last week is a reminder that currencies are not just numbers on a screen, they are the price of everything on an economy, imports, the value of everything its citizens hold abroad, and a political barometer for whether a government is keeping its people's purchasing power intact. Now, the negatives of this is Japan's households are paying more for their electricity because of the number on a chart that has been moving in one direction for years. The intervention is the government's attempt to tell the market that this will not be allowed to continue, backed by the weight of the United States Treasury. Yeehaw! Whether that statement holds depends on something no intervention can control: the interest rate differential between two of the world's largest central banks, and how quickly the Bank of Japan is willing to close it. I mean, the notepad said 5-10 billion, so the structural problem is measured in decades. Thank you all. Bye-bye.